All right, so good evening, sisters. Good evening once again. I would like to welcome you to our introductory session on FAC 2602. Right. So now, just to before I can actually begin to talk about the outline of these essential topics, I just want to give you guys an overview of how FAC 2602 is structured. Right. So to do that, I'm going to be illustrating through the whiteboard screen, which we'll be sharing on your screen shortly. So I just want to get a confirmation from you. Can you all see the shared whiteboard screen at the moment? Is it visible?
Yes, I can.
Okay. All right.
Yes.
Okay, thank you so much. All right, now let's proceed. So now, FAC 2602, it's a module structure that is made up of two essential aspects, which is namely, number one, business combinations, which I would introduce you to today. Right, business combinations, which is also commonly known as consolidations or business consolidation, so to speak. Right. So majority of the various learning units or topics that I'm going to, of course, outline is as I take you to the PDF document, they are all really within this umbrella of business combinations, or what we call business consolidation. And then secondly, you're also going to deal with the cash flow statement, or what they commonly call the statement of cash flows. Statement of cash flows. Right. These are the major two aspects that you'll be dealing with in FAC 2602. Right. So as you know that there's been a module structure, or a different, or rather a change in the module arrangement concerning FAC 2602, there will be no examination that you guys will be expected to write for this particular module. However, there will be assignments that you'll be expected to complete almost under exam conditions. That's this new structure that they've actually bring together in this particular academic year, which is of course the 2023 academic year. So you discover that for almost each one of the respective assignments, which the lecturer has actually put together, there will be specific learning units that you are expected to have studied and mastered for you to be capacitated enough to answer the assignment questions, right? So it's very important that I would take you through that. So one of the two important learning units that I'm going to cover in today's session, I would cover them, but at a high level without getting yet into details. It will be your learning unit 1 and your learning unit number 2. All right.
Being recorded.
Okay. Right. So it will be learning unit 1 and learning unit 2 that I'll be covering today. Right. And then, of course, learning unit 3, I would be dealing with it on a separate session altogether, right? So without any further ado, sisters, what is business combinations? What is this thing called consolidation? So in order for you to have a good understanding of what business combinations really entail, here are some important pointers that I want to put across to you. So business combinations or consolidation, right? What do we mean by this? So when we are saying business consolidation, or business combination, we're simply saying one company decides to acquire some shareholding in another organization in order to formulate what we call a group company. So to illustrate this in a simpler manner, I would give you two examples, which I would denote here. Company P Limited being what I would call a parent company. For them to form what we call a business combination, P Limited need to acquire some shares in another organization, which I would call here S Limited, or rather, let me say S1 Limited. Okay? Like that. And not only that P Limited is limited in acquiring shares only in that one particular organization, they may decide to acquire shares again in another entity altogether, which I would call in this case S2 Limited. Right, like that. So I want you to notice what is happening. So P Limited, which in this case stands for the parent company, right? For them, or for it to actually form together what we call a business combination or consolidation, they needed to acquire some shares in another organization or in other organizations in order for them to establish one reporting entity. So when that happens, when P Limited buys shares in S1 Limited and buys again shares, for instance, in another organization, in this case, S2 Limited, what would happen is for financial reporting purposes, P Limited as a group company is expected to produce what we call consolidated financial statements. Consolidated financial statements, which I would denote there as FS. So the question is, what are consolidated financial statements? Now, consolidated financial statements simply means we combined the financial statements of all these companies in the group. So we are saying we are taking financial statements of P Limited, financial statements of S1 Limited, and financial statements of S2 Limited, and we are combining them together. And that process of combining them together, we call it consolidation. So I'll call this consolidation process. So during the consolidation process, what is happening is you have individual financial statements of all these three respective organizations, right? So what will happen is when we now produce consolidated financial statements, we are looking at their individual financial statements. So what do I mean when I'm saying we are looking at their individual financial statements? For instance, if I look at P Limited as one reporting entity, they would have the statement of profit or loss, which I would indicate here as SPLOCky. SPLOCky stands for statement of profit or loss and other comprehensive income. I repeat, statement of profit or loss and other comprehensive income, which back then they used to call it income statement, right? Not only that, they will also have statement of financial position, which was commonly known as the balance sheet, right? And then, of course, they'll also have, apart from these two that I've mentioned, they'll also have the statement of changes in owner's equity, which I will simply denote as SCE, statement of changes in equity, right? And not only that, but for this particular module, you will not deal with the consolidation of the statement of cash flows. Hence, I mentioned that the two major aspects concerning this particular module is business combinations, but only addressing the following financial statements, the three that I've already outlined for you over here. You will not deal with consolidated statement of cash flows at this particular level. So in FAC 2602, as far as consolidated financial statements are concerned, you are not going to deal with consolidated statement of cash flows. All right, please take note of that. That's a very important point that I've put across to you. So the only consolidated financial statements that you're going to be dealing with, it's these three that I've put across here. Statement of profit or loss and other comprehensive income, the statement of financial position, and then of course, the statement of changes in owner's equity, right? So now, don't lose me on this one. I'm doing this with illustration. Of course, there's theory and all that surrounding this, but I want you guys to have an overview understanding of what does it mean when we're saying business combinations, or when we say business consolidation. What exactly is it that what is the principle behind it? That's what I want you to understand. All right, so don't worry so much about the details as yet. We'll get to that stage. But now, so look at this. P Limited has got their own individual financial statements. And the same would be true for S2 Limited. It will also have its own individual statements, which is in the same umbrella of SPLOCI, SFP, Statement of Changes in Owner's Equity. And if I look at S1, they'll also have their own individual statements. But now, because P Limited decided to form a business combination by buying shares in S1 Limited as well as in S2 Limited. So what would happen is now, by law or in terms of the standard of accounting, they are expected now to report as one organization. And because they are expected to report as one organization, it means they are supposed to generate or produce what we call consolidated financial statements. So these consolidated financial statements can only exist or can only manifest if they follow what we call the consolidation process. So the consolidation process is simply a process where we are taking the financial statements of this organization and the financial statements of that organization, as well as the financial statements of that other organization, and then we are taking 100% of each one of the line items in those financial statements, and we are combining them in order for us to form one thing. So let me give you an example. Like, for instance, if you go in your statement of profit or loss and other comprehensive income, you know, sisters, that, okay, in the statement of profit or loss, SPLOCI, right? Your line items normally is revenue, right? So you've got revenue, you've got cost of sales, then of course you're supposed to have gross profit here. Then of course you would have other incomes somewhere there. Okay, what happened? Okay, other incomes, and then of course you would have administrative expenses somewhere there. Okay, I'm just illustrating, and then of course this would need it to be able to determine the profit for the year, right? These are things that you find in your SPLOCI, your statement of profit or loss, and other comprehensive income, right? Something like that. Now, I don't want you to lose me here, right? Something like that. And then let me do it this way. Because these things will only make sense with illustrations, right? Because it's accounting. And then, of course, with practicality as well. So with expenses, obviously, you subtract them. So what we are saying, my sister, when you're following, so what I'm trying to explain here is the practicality of the consolidation process. So remember, you have the three companies that are separate and they are producing their own financial statements individually, right? But when we are now supposed to report in a group setup, what we are saying is, if I look in the statement of profit or loss of P Limited, I'm supposed to take 100% of the revenue coming from P Limited. And what I'm saying is, if it's 100,000, that P Limited is generated with, we write 100,000 here. Are we together? Then we add also 100% of revenue line item, which is coming from this other organization, which is S1 Limited. So here I'm going to put S1 Limited. And then we also do the same. We take 100% of the revenue that was produced by the other company. So when we are adding these individual amounts that are coming from the line item revenue in the individual financial statements of these three respective companies, what we have simply done right there, my sisters, we have consolidated this line item revenue in our consolidated financial statement called SPLOCI, which is basically the income statement. So that's how the consolidation process works. So you're simply taking for each line item, you're simply saying, I'm taking so if it's cost of sales, you're also taking 100% of the cost of sales of P Limited plus 100% of cost of sales coming from S1 Limited plus also 100% of the cost of sales coming from the other organization, in this case, S2 Limited, right? So now this is what we call consolidation. So consolidation, you're simply taking 100% of the individual line items from the different organizations within the group setup. That's what we are doing. Now, before we go far, I want you to understand what is happening in the process of business combinations as well. So now, we have P Limited that has bought shares in S1 Limited. Now, the moment P Limited acquires shares in S1 Limited, and for as long as the shares they are buying, it's more than 50%. For as long as it's more than 50%, in other words, 51% and above. All right, so I'm saying P Limited has bought shares in this organization, and for as long as the shareholding that they hold is above, all right, it's above 50%. In other words, 51% and above. What we have in that setup, we have a parent to subsidiary relationship. Please write that down. We have a parent to subsidiary relationship. So in other words, the company that is buying, that is what we call the parent company, or that is what we call the holding company. So I think to make it easier so that it looks neat and clean, let me open another screen. So we are saying P Limited, for as long as P Limited, all right, buys shares in I'm just going to illustrate this with S1 Limited so that it becomes easier. So for as long as the shares that P Limited is buying in S1 Limited is more than 50%, in other words, 51% and above, what we have is we have a parent to subsidiary relationship. We have a parent to subsidiary relationship. That is the type or the nature of a business combination which will be formed. Okay? And throughout all the types of business combinations, I mean, the different types of lending units you'll be dealing with, you'll only be dealing with this type of a business combination, which is a parent to subsidiary relationship. Are we together, sisters? Hello? Talk to me.
Hi, can you hear me?
Yes.
So on the statement of comprehensive income,
yes,
just the one that you had done.
Yes.
You said that they're going to present the revenue at 100%, right? Is it also applicable if they're not majority shareholders?
Repeat again.
I'm saying by the revenue side, on the
Yes.
statement of comprehensive income there.
Yeah. Yes.
You're saying that the revenue is going to be 100%. 100% of the revenue is going to be recorded on the statement.
Yes. Of the parent company. Yes. Correct.
Is this still applicable if they are not majority shareholders?
Oh, yes. Oh, yes. Oh, yes. The same would apply. But you see now, on that note, I would explain it when we go to learning unit number 3, so that you can see the difference.
Okay.
Yeah. Because you see, all right. I think so that it becomes clear and I don't confuse you guys. So we are saying that in this setup, for as long as the shares that the parent company, P Limited in this case, acquired in the subsidiary company S1 Limited, for as long as it's above 51% and above, we have what we call a parent to subsidiary relationship. That is the type of relationship that exists. However, expounding further on that relationship between the parent company and the subsidiary, what would happen, guys, is, and to answer your question now, what would happen is the parent company, I'm just going to indicate that is P Limited, right, can acquire 100% shares in the subsidiary, in this case, S1 Limited. So when that happens, we call this form of a business combination a wholly owned subsidiary. Wholly owned subsidiary. So in other words, this type of subsidiary we have in this business combination, it's a wholly owned subsidiary. So it means P Limited owns everything in that particular organization. So even now, when we do the consolidation process, yes, we are taking 100% of the parent company, P Limited, as well as 100% of S1 Limited, right? Now I'm going to illustrate also now a different type of a subsidiary relationship, but which we will tackle in detail in learning unit 3. So we have got P Limited again. But in this case now, P Limited is not buying. In fact, let me use a different color to make it easy for you to see the difference. But in this case now, what is happening with P Limited is that P Limited is acquiring shares in S1 Limited, yes. However, P Limited is not buying everything in its entirety in this particular subsidiary. They only bought, for instance, 80% of the shareholding in this subsidiary. So in this context, my sisters, the nature of a business combination that we have what we call a partly owned subsidiary. A partly owned subsidiary. Right. So why do we say partly owned subsidiary in this case? It's simply because, I mean, the parent company P Limited did not buy everything in the subsidiary. In other words, they do not own entirely every shareholding or shares rather in the subsidiary S1 Limited in this context. So the question is now, what about the other 20%? Who does this 20% belong to? You might be asking that question because in the consolidation process, we need to account for this as well. Okay, so now that 20%, which the parent company does not own in the subsidiary, it belongs to what we call non-controlling interest. All right, please write it in for, I'm just abbreviating because of the space, but this term NCI simply stands for non-controlling interest, right? So those are the other shareholders in the subsidiary S1 Limited in this context. So there's a different way that we also need to account for the portion that belongs to these guys as part of our consolidation process. However, the process still remains the same, guys. All right, still remains the same, except that remember that we need to also account for the non-controlling interest. But what is happening is we are still taking 100% of the revenue in the parent company, and we are still taking again 100% of the revenue that we own in that subsidiary, though we do not own entirely everything, but the 100% is in the sense of saying the portion that we are owning, we are taking it, all of it in its entirety, and we have to actually consolidate it in this case. But there's a calculation that you need to do in order to determine the portion, that 80% that you own. All right, that 80% that you own. So you do not necessarily have to say, for instance, now in this case, when you're doing consolidation, you do not have to now say here, when I put the revenue for S1 Limited, then I take, for instance, 80% of what is in S1 Limited. You don't do it that way. You'll be wrong. So for instance, if maybe say the revenue in S1 Limited is 100,000, and then you say, okay, fine. So I'm going to take that 100,000 times 80%, then I put that figure here. It will be emphatically wrong. Why am I saying it will be emphatically wrong? Because when we now have this form of a business combination where the subsidiary is partly owned, remember there's these other guys as well that we need to account for in as far as revenue is concerned. And that is why you would notice as part of the calculations that you're going to do, all right, as part of the calculations that you're going to do, and you would see the same anyways, the same calculation, except that in this case, we will not be accounting for these guys. You would see this calculation in both. We call this the analysis of owner's equity. Analysis of owner's equity. This is a very, very important calculation that needs to happen in order for us to correctly account, for what actually belongs to these guys, the parent company, and the portion that belongs to these guys, which is the non-controlling interest. So when we do the analysis of owner's equity in a setup where we have a partly owned subsidiary, all right, we will disseminate between what belongs to these guys and what belongs to these guys. So even if S1 Limited had made 100,000 rands as profit, the moment we have this form of a subsidiary relationship, we have to draft this analysis of owner's equity. Why? Because there will also be some dividends that will be paid and all that, and even some intra-group transactions. But these things, you learn them later. Don't worry about them, which need to be dealt with in the analysis of owner's equity, right? And when we do that, we will be able to correctly account or correctly disseminate what truly belongs to the parent company and what also belongs, of course, to the non-controlling interest. So now, in other words, when I'm now taking, for instance, the revenue or the profit that has been made by this organization, the subsidiary, from the analysis of owner's equity, I'll be taking the figure that also, in other words, the figure that I will now put here, guys, the figure that I will now put here, and I just need to remove this 80 because it's not supposed to be that. So now the figure that I'll put here, which I will then, of course, account as 100% of what belongs to the subsidiary, it will be coming from the analysis of owner's equity. So I'm saying this amount, which I will put over here for the subsidiary in the setup where we have this, where we have a partly owned subsidiary, it will be coming from this calculation. All right, but you don't need to worry about it for now. Please don't worry. For now, what I'm laying the foundation so that you understand the principle, the dynamics around the different types of subsidiaries you'll be dealing with. So guys, for the purpose of this module, FAC 2602, these are the two important types of business combinations, subsidiary combinations, as in this case, because both of them anyways, you'll be dealing with subsidiaries. So these are the two types of business combinations you'll be dealing with, where we have a wholly owned subsidiary and the other where we have got a partly owned subsidiary. It's very important. And like I said, the analysis of owner's equity would be existing in both of these two types of business combinations. So let me put it here. So you also do here in the wholly owned, the analysis of owner's equity. You also do it when you're dealing with this type of a business combination. But the exception now is that, and please take note of this thing I'm writing down now, no account for the non-controlling interest. So when you do the analysis of owner's equity for a wholly owned subsidiary, you do not account for the non-controlling interest shareholders. Why am I saying that? Because they do not exist, because we own everything in this setup. So P Limited owns everything that is happening in the subsidiary. So there will be no need for you to account for the non-controlling interest. In this case, under normal circumstances, this will be the simplest business combination you could ever deal with, actually. But in reality, when you look at organizations and the type of business combinations that they formulate out there, it's not always the case that they would own everything in a particular subsidiary, but you would have a situation rather where they only own a portion of some shares. Of course, there'll be the major shareholder in that case, but they'll own a portion of shares in the subsidiary. So when that happens, it means we now need to account for the other portion that they do not own. And that is what we call the non-controlling interest. And that non-controlling interest, it has to be accounted for, in this case, in the analysis of owner's equity of that organization, for as long as it's a partly owned subsidiary. Very, very, very important. And another important thing I just want to point out, what we're going to do is we're going to come, okay, this meeting is going to end now. We're going to rejoin again, because I just want to show you also with some illustrations of actual financial statements, and then I'll be showing you the process with examples in reality, so that it really begins to make some sense to you. But we'll do the examples in detail in the next session. But for now, I just want to make sure that at least you have perspective of what is going on. And then another important thing I just wanted to then put across again, after explaining the two types of business combinations, that when you do the consolidation process, guys, remember you're taking 100% of what is in the parent company. Always it's like that. And then plus 100% of what belongs to the subsidiary. All right, whether it's partly owned, whether it's wholly owned, doesn't matter. But remember, the condition is that when you now take the revenue, especially from the subsidiary, there has to be an analysis of owner's equity that you should have drafted, or rather that you should have actually performed. All right, in order for you to correctly account for the revenue. Okay, so it's very, 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 very important. Right. But another thing I just want to put across again before I take you to the actual exam and before this particular segment ends is that the parent company, P Limited, and its subsidiary can actually enter into transactions together. Certain business transactions together. So when I'm saying certain business transactions, or rather they can transact together, what do I mean? I'm simply saying that we can have a situation where, for instance, P Limited buys something, all right, from who? From S1 Limited. Or it can be vice versa. Now, when that happens, in other words, when there is an intra-group transaction between P Limited and S1 Limited, what needs to happen is that every time there is a type of a transaction like that, where one company in the group is buying from the other company, or one company in the group is selling to the other company, what always needs to happen, and please take note of this. It's a principle I'll teach you later on in Learning Unit 7, but I just thought it's important that I just, put across that that factor into account. So when that happens, guys, we have to eliminate the intra-group transactions. Now, there's a process that we follow when we are eliminating the intra-group transactions. And you'll notice that as we are doing that process at a later stage, of course, like I've mentioned, when we do that particular process, what would happen is in the analysis of owner's equity, some of those intra-group transactions will need to be actually taken into factor. And not only in the analysis of owner's equity, right? But you also might, to a certain extent, account for them even in the actual financial statement. So for instance, in this particular setup where we have a explore key, you might need to add some of those intra-group transactions here and subtract some of them over here. But the process of adding or subtracting, the ultimate thing we are simply doing is to eliminate that intra-group transaction. And the reason why we have to eliminate the intra-group transaction is because as a group company, in other words, when we now report, all right, on our group financial statements, we cannot profit from ourselves, all right? The group company cannot make profit out of itself. We only are expected to make profits with third parties. So the transactions we are supposed to present in our group financial statements should be transactions that we've entered into with third-party entities, not with ourselves. So that is why we need to eliminate the intra-group transactions when we produce our group financial statements. So what's going to happen now? We're going to get into the second segment. So because this particular one is going to end, so you still use the very same link to reconnect. So I'll communicate now shortly on the WhatsApp group. Thank you so much.